Welcome to the Deep Dive. Japan's beloved retail and food giants, these are companies that once seemed like symbols of just unwavering stability.
Absolutely. Unshakable.
Right. And now they're undergoing this dramatic, almost unimaginable metamorphosis. It's not gradual change anymore.
No, not at all. We're really seeing a complete corporate re-architecture, and it's being spearheaded by a force many might not expect. Private equity.
Private equity, yeah.
It's really a pivotal moment. And what's fascinating, I think, is how these PE funds are stepping into this void. They're not just, writing checks.
Right.
They're actively hands-on. They're injecting management know-how, driving digital transformation, DX, supporting M&A, and even, implementing some tough structural reforms to really boost company value.
And it's important to understand their typical playbook, isn't it?
Exactly. They acquire a company, often taking it private, unlisted. Then they work intensely, usually over maybe 5 to 7 years, to boost its value through all these strategic and operational reforms. And then they look for an exit. That could be an IPO, taking it public again, or maybe a strategic sale to another company.
That playbook is precisely what we're here to unpack today. Our mission for this deep dive is really to take you through specific real-world examples.
Yeah, the actual deals happening now.
Exactly. Major Japanese companies in retail and food that are currently owned by or have just recently been acquired by these PE funds. We want to peel back the layers, understand the why and the how behind these huge shifts.
And hopefully we can reveal some surprising facts about brands you probably know, brands you interact with. It's a shortcut, really, to understanding the cutting edge of Japanese industry right now.
Okay, so let's start with the big picture then. This whole PE-led reorganization. Recent years have seen some truly major, almost symbolic reorganizations across Japan's large retail sector.
Big names.
Yeah, long-established supermarkets, even department stores, being spun off from their giant parent conglomerates. This isn't just moving money around.
No, it's changing the fundamental structure of the industry. It's quite profound.
So where do we start? Let's dive into some of the biggest, most symbolic cases first.
Right. First up, let's talk about York Holdings. This is the intermediate holding company that Seven & I Holdings formed just last year, 2024, to reorganize its supermarket business.
Okay.
And it holds some really iconic assets. You've got the 100-year-old Ito-Yokado general merchandise stores, the GMS. These are the big multi-department supermarkets.
A staple, really.
Exactly. And then there's the regional powerhouse, York Benimaru, which is really known for its focus on fresh food. And interestingly, York Holdings also inherited some non-core Seven & I businesses, things like Akatan Honpo, the baby product store, and the Denny's family restaurant chain.
Right, so Seven & I, they were facing immense pressure, weren't they? Fierce competition, changing consumer habits. They had to reform that core supermarket business.
They absolutely did.
So here's where it gets really interesting for me. Bain Capital steps in. What was it about their offer, or maybe their specific approach, that sealed this huge deal, especially given Ito-Yokado's legacy, that sort of community infrastructure role it played for a century?
Well, Bain Capital has a pretty strong track record in Japan. Think Skylark, Domino's Pizza. Their playbook isn't just about capital.
Right.
It's about this relentless focus on operational efficiency and critically aggressive digital overhauls. They signed the agreement back in March 2025 to acquire a majority stake.
A majority stake. Okay.
Yeah, in York Holdings. The price tag was estimated at $815 billion. That's roughly $5.4 billion US. Huge number.
Wow.
And Seven & I, they're keeping about 35% of the shares. Even the Ito family, the founders, are holding on to about 5%. So there's still some skin in the game from the original players.
So Bing's not just throwing money at it. What's their actual plan?
Their strategy for York Holdings involves really comprehensive reforms, things like store optimization, maybe closing some, refurbishing others, big focus on supply chain efficiency, strengthening private label products, their own brands, and introducing much more digital marketing to boost profitability. It's a multi-pronged approach.
And as of right now, July 2025, this acquisition has just completed. It's off the stock market, unlisted. So we can expect pretty intensive reforms over the next few years before they even think about an exit.
That's the typical timeline, yes.
When you look at the sheer scale of this deal, it really feels like a kind of litmus test for the future of Japanese retail, doesn't it?
It really does.
What specific signs should we, or maybe you, be watching for to gauge if it's working, especially balancing that efficiency drive with the sort of community role Ito-Yokado had?
That's the million-dollar question, or rather the $5.4 billion question. We need to watch customer retention after they roll out more digital tech. Can they integrate it without alienating loyal, maybe older shoppers?
Good point.
And can they streamline operations, improve that supply chain without sacrificing the fresh food quality that York Benimaru is famous for? That's a delicate balance.
Okay, so from one massive retail overhaul, let's shift focus. Another significant transformation, this one with a really storied past, Seiyu.
Ah, yes, Seiyu, a supermarket chain with roots way back in 1956. A true pioneer in the GMS format here in Japan.
And it spawned some huge names, right?
It did. It was the origin for Family Mart convenience stores and Ryohin Kaikaku, which everyone knows as Muji.
Wow, I didn't realize that connection.
Yeah. Then, from 2008, it became a wholly owned subsidiary of Walmart. That's when they brought in the everyday low price strategy.
Right, EDLP.
Exactly. And today, Seiyu still has around 300 stores, sales around $1 trillion, still a major player.
But the Walmart ownership, the reforms were apparently quite slow.
They were slower than expected, yes. So Walmart started looking for partners. And in 2021, KKR, the global PE fund, and Rakuten Group acquired 85% of Seiyu.
Rakuten was involved initially.
Yes, though Rakuten actually exited later in 2023. But under KKR's leadership, Seiyu saw massive changes, really accelerated things.
So what did KKR bring specifically? What allowed them to speed things up where Walmart maybe struggled?
Well, KKR brought not just capital, but really deep expertise in large-scale corporate turnarounds and, crucially, digital integration.
Okay.
So they drove large-scale store innovations, major logistics system reforms, and really strengthened the online supermarket business. They leveraged that Rakuten partnership heavily at the time. The goal was true digital-physical integration, omni-channel, basically.
Makes sense. So what does this all mean now? KKR's in, they made changes.
Right. So PE funds, as we said, usually aim for that 5 to 7 year exit window. For KKR, the timing felt right. In March 2025, KKR successfully exited.
They sold it.
They did. Sold Seiyu to Trial Holdings. Trial is an emerging discount store giant based down in Kyushu. The price was approximately $380 billion.
And that just completed.
Just completed, July 1st, 2025. This is really a textbook PE fund success story.
Wow.
Buy, improve, sell.
It certainly looked like a win-win on paper. A huge strategic gain for Trial Holdings. Right. You get to expand massively into Kanto, Chubu, Kansai regions. Pushes their group sales over that all $1 trillion mark.
Definitely a big strategic move for Trial.
But, you know, when you merge two very different corporate cultures, Seiyu with its history, Trial with its discount focus, what are the potential sort of integration pitfalls? What does Trial need to watch out for?
That's a really important point. Trial HD is known for being very cutting edge, using AI, lots of data-driven operations. Seiyu has a more traditional operational model, partly from its history, partly from the Walmart era.
Right.
So the challenge for Trial will be integrating those, applying their advanced systems to Seiyu without disrupting Seiyu's existing customer base, its supply chain. And then there's the whole cultural assimilation piece, getting two different workforces to mesh. It's never straightforward.
Yep, never is. Okay, case number 3, another big one, Sogo and Seibu.
Ah, the department store saga.
Exactly. A merger of two truly historic department store names. Seibu founded 1949, Sogo way back in 1830. We're talking iconic stores like Seibu Akebukuro.
Institutions.
But they've faced this long-term decline, haven't they? E-commerce hitting them hard, shoppers shifting to specialty stores, plus their buildings are aging. It basically became labeled as unprofitable within the Seven & I group.
Yeah, a drag on earnings. So Seven & I had been trying to sell Sogo and Seibu for years. And what's fascinating here is just how tumultuous that sale process was.
Tumultuous is putting it mildly.
It eventually went to Fortress Investment Group, which is backed by SoftBank. The price was $220 billion, finalized in September 2023. And that was actually down from an initial agreement of $250 billion.
The drama around that deal, I mean, a labor strike over a department store. In this day and age, it really shows how deeply embedded these traditional brands are in their communities, doesn't it?
It absolutely does. It's more than just a store.
So what made this sale so contentious? And what on earth is Fortress's plan? It seems pretty radical for reviving what many see as a dying format.
Well, the main flashpoint was the plan to bring Yodobashi Camera, the big electronics retailer, into a large part of the flagship Seibu Ikebukuro store. The labor union and also the local Toshima ward government strongly opposed that. They were worried about the department store's image, job losses, the whole character of the place changing.
Okay, so that's the conflict. What's Fortress's angle?
Fortress has deep expertise in real estate and revitalization. They're not just buying a retailer, they're buying prime urban real estate.
Ah, the property play.
Exactly. Their core plan involves that strategic partnership with Yodobashi Holdings. The idea is Yodobashi will bring in massive foot traffic, new kinds of customers, into flagship stores like Ikebukuro.
Interesting. So use the electronics giant to save the department store.
Sort of. And Fortress has also committed over $20 billion for renovations within 2 years. Plus, they officially promised to maximize employee retention, likely to try and smooth things over after the strike in opposition.
Okay, so as of now, July 2025, Sogo Seibu is still unlisted, under Fortress, active reconstruction underway. The big question, I guess, for you listening is, how will this combination, a PE fund focused on real estate and a giant electronics retailer, actually succeed in reviving a traditional department store? But what does that mean for the department store experience in Japan going forward?
It's a fascinating experiment to watch. Now let's shift gears a little. Because the role of PE funds, it isn't just about these huge corporate reorganizations, these massive carve-outs or turnarounds.
Right.
Especially here in Japan, they're becoming increasingly important in another area, supporting business succession, helping founders transition, and also boosting growth in solid mid-sized companies, particularly in the food sector.
That's a great point. In our next case, Hiiragi Holdings fits that perfectly. This is a diverse food service and retail group based down in Miyazaki in Kyushu. Founded back in 2002 by Shoji Hiiragi. They operate about 140 stores across the country. Many are popular franchises people will know, like 31 Ice Cream, Kuzufuku Shoten, that gourmet food store, Kushikatsu Tanaka, the fried skewer chain.
Good mix.
Yeah, plus they have their own original brands like Bib and Tai, and they've even acquired some historic local brands like Chateau Bunkyo, so quite diversified.
So Hiiragi Holdings, they were looking for a partner, right, for their next growth stage, but also for smooth business succession down the line.
Exactly. And in December 2023, Sunrise Capital stepped in. That's the private equity arm of CLSA. They invested, providing financial and strategic backing.
Okay.
But importantly, the founder, Mr. Hiiragi, he's still in charge, and the founding family remain shareholders.
Ah, that's a crucial difference from some of the other deals we discussed. The founder's still at the helm.
Yes. So how does Sunrise Capital's involvement differ in that scenario? When the founder is still driving the bus, so to speak, what kind of specific growth opportunities do they help unlock then?
Well, when the founder remains, the PE fund often acts more like a strategic accelerator, rather than a full turnaround manager imposing a completely new vision.
Right, more of a partner.
Exactly. They bring their network, their M&A expertise. So Hiiragi Holdings, with Sunrise's backing, is now actively expanding. A great example is their reported acquisition just this month, July 2024, of Papalama. It's a fresh pasta chain.
Okay, so Sunrise helps them make bigger moves.
Precisely. Sunrise provides the resources and the know-how for maybe larger M&A targets or entering new markets, things that might have been a stretch before, all while leveraging the founder's deep, intimate knowledge of the business itself.
So as of July 2025, they're really in the early stages of this kind of medium to long-term value enhancement plan. It really could become a model, couldn't it, for how regional companies can achieve significant growth with PE support, not just by being taken over.
It's definitely a model to watch. Now, our fifth case, Kabaya Foods, shows another interesting angle, blending deep tradition with very modern strategy.
Kabaya Foods,
Okay.
the confectionery maker.
That's the one. Long established, based in Okayama, founded way back in 1946. They make some really iconic products. Kabaya caramel, juicy candies, tough gummy, the salt charge tablets you see everywhere in summer.
Ah, yeah, know those.
They're a major player in Japanese confectionery. Annual sales around 30 billion.
So a solid traditional company, why bring in PE?
Well, Kabaya decided they needed a new partner for, again, further growth, but specifically for digital adaptation, getting up to speed with the modern market.
Makes sense.
So in May 2024, a Tokyo-based PE fund called D Capital acquired about 70% of Kabaya Foods.
D Capital, and they have a specific niche, right?
They do. D Capital has this unique DXXPE investment strategy. DX meaning digital transformation. They focus specifically on using digital tech to create value. Their past successes include names like Frank, the home furnishings retailer, and Oyatsu Company.
Oyatsu, Baby Star Ramen.
That's them. So D Capital knows how to work with established brands.
Okay, so how do you actually inject a cutting-edge DX approach into a pretty traditional confectionery brand like Kabaya without, losing its core appeal or alienating its loyal customers?
That's absolutely the key challenge. And D Capital's strategy seems pretty clear. They want to combine Kabaya's strengths, strong product development, recognized brands with their own digital marketing and DX expertise.
How specifically?
Well, things like using social media much more actively for finding new fans, new demographics, using data analysis much more deeply for product development, figuring out what flavors or formats resonate, where, with whom, and also applying digital transformation to make the supply chain more efficient so it touches multiple parts of the business.
It raises an important question, though, doesn't it? Can a brand like Kabaya, with that long history, truly transform and thrive with these cutting-edge digital strategies? Or is there a real risk of, I don't know, feeling inauthentic or alienating the people who've bought Kabaya caramel for decades?
It's a valid concern. Finding that balance will be critical. As of July 2025, Kabaya Foods is unlisted under D Capital. The focus is definitely on new products, expanding market share, and maybe even future overseas expansion. We're definitely eager to see the chemical reaction from this rather unusual pairing.
Yeah, tradition meets tech. Okay, next up, QSAI Corporation. You called this one unconventional.
Yes, QSAI, based in Fukuoka. They're known for health foods and cosmetics. Their most iconic product is probably the kale green juice, Aojiru. You might remember the old TV commercial.
Oh, yeah. The Mazui Mui Pie. Ugly. One more.
That's the one. Classic. QSAI has had a pretty complex capital history. It was even under Coca-Cola West for a time, but now it has a stable revenue base, mostly from subscription-based direct sales. Mail order, online.
Okay, so Coca-Cola Group sold it, and you said the buyers were an unconventional alliance. Let's unpack this joint acquisition.
Right. So in January 2021, this unique three-company alliance bought QSAI. It was Advantage Partners, a major independent Japanese PE fund.
Okay, standard PE.
Then Euglena, the bioventure company famous for its namesake microalgae ingredient.
Ah, Euglena, right. Very different.
Very different. And the third partner was Tokyo Century, a major leasing and finance company.
Wow. A PE fund, a biotech company, and a finance company. They each clearly bring different strengths, but how do these diverse players actually, work together? How do they create synergy in practice?
That's the critical point, and it's quite innovative. Euglena actually made QSAI a consolidated subsidiary, so they're actively driving the operational synergy.
How so?
They're combining Euglena's R&D capabilities, their ingredient tech, with QSAI's well-established mail-order know-how and large customer base. Think joint product development, cross-selling Euglena products to QSAI customers, and vice versa.
I see. And Advantage Partners, the PE fund.
AP's role is more about supporting the overall management, providing strategic oversight, financial expertise, and really ensuring these synergies are maximized effectively. It's a very collaborative model, less about one entity imposing its will.
Interesting structure. So as of July 2025, QSAI is unlisted, and they're focusing on building a foundation for kind of a second growth spurt.
Exactly. New product development, enhancing digital marketing, potential overseas expansion, all leveraging that Euglena collaboration. It's a unique setup.
Definitely. Now, you mentioned another key investment theme for PE funds earlier, carve-outs.
Yes, carve-outs. This is a really important area. It's basically where large corporations decide to sell off businesses or subsidiaries that aren't core to their main strategy. Maybe they're underperforming or just don't fit anymore.
To streamline, focus their efforts.
Precisely. And PE funds often see great potential in these carved-out entities. They step in to help these newly independent businesses not just survive on their own, but really thrive, free from the constraints of the larger parent company.
Okay, so let's look at an example. Our seventh case, LB Co., Ltd.
Right, LB Co. They're based in Saitama, and they manufacture beverages, specifically chilled drinks and lactic acid beverages like yogurt drinks. They have a long history, founded in 1956, but their major strength today is OEM production.
Making drinks for other brands.
Exactly, for major beverage companies and also for convenience store private brands. It's a big business. They'd been a wholly owned subsidiary of Asahi Group Holdings since 2011.
Part of the Asahi beer giant. So why did Asahi sell them?
Well, LB was carved out as Asahi Group reviewed its overall business portfolio, standard practice for big conglomerates. In November 2017, Polaris Capital Group acquired all of LB's shares.
Polaris again. We heard about them earlier.
Yes, the same fund involved with Bussan Food Science later on. Polaris has extensive experience specifically in these carve-out deals. Their goal with LB was clear. Free it from the corporate constraints of being part of Asahi.
Let them be more agile.
Exactly. Enable more nimble, independent management focused solely on LB's growth. pursue opportunities that maybe didn't align perfectly with Asahi's core beer and beverage strategy.
Makes sense.
Yeah.
So that was back in 2017. How has LB done since then under Polaris?
They've definitely worked on profitability. Revenue has reportedly increased since 2017, but challenges remain, especially on the profit margin side.
Why is that?
Partly due to investments in developing new products, trying to grow beyond just OEM, and partly, like many food and beverage companies, dealing with rising raw material costs. It's been tough to maintain margins.
Okay, so as of July 2025, still unlisted under Polaris. Now, you said PE funds like Polaris typically aim for a 5 to 7 year holding period, 2017 to 2025. That's getting close to or even past that window.
It is. So an exit, either an IPO or a sale to another company, is likely on the horizon for LB.
But maybe not immediately.
Probably not immediately. The immediate focus likely remains on further business structure reform, shoring up those profit margins, really enhancing the value before they take it to market for an exit, getting it into the best possible shape first.
Right, maximize the return. Okay, let's shift gears slightly to Bussan Food Science Ltd., also involving Polaris, you mentioned.
Correct. Case number 8. Bussan Food Science is based in Aichi. They're a B2B manufacturer, business to business. They make functional food ingredients.
Things like xylitol.
Exactly. Xylitol, maltitol, various food fibers, emulsifiers, ingredients that go into other companies' final products. They have a 50-plus year history and have achieved what you'd call niche top status. Meaning they're a leading specialist supplier of these essential ingredients, particularly for health-conscious food products. They're a go-to source in their specific market segment. They were a wholly owned subsidiary of the trading giant Mitsui & Co. since 2002.
Okay, another carve-out from a huge corporation. Mitsui streamlined its portfolio.
And in January 2025, just this year, Polaris Capital Group acquired all the shares of Bussan Food Science.
So Polaris sees potential here too. They recognize Bussan's unique Japanese technology, its niche leadership. How does spinning off from a giant trading house like Mitsui actually help enhance their global competitiveness, especially with the functional food market booming worldwide?
Well, again, it comes down to agility and focus. Being independent allows Bussan Food Science to be far more nimble.
How so?
Polaris can enable direct, focused investments into things Bussan needs to grow globally, like increasing production capacity, maybe building new factories specifically for export markets, or aggressively expanding their overseas sales networks.
Things that might have been slower or lower priority within Mitsui.
Potentially, yes. Under a large, diversified trading house, resource allocation can be complex. Now, as an independent company backed by a PE fund focused on its growth, Bussan Food Science can move faster, be more flexible, and really capitalize directly on those global trends in functional foods.
So the acquisition by Polaris just completed recently. Growth investments are likely just starting now. Building factories, expanding sales.
That's the expectation, yes. The company seems poised for much more flexible, independent growth now.
Okay, one final case. Let's talk about Nitto Sweets.
Right. Case number 9, Nitto Sweets. They used to be called Nitto Konom, based up in Tochigi. They're specialists in oimodium original equipment design manufacturing of frozen sweets and prepared foods.
So making desserts for others again.
Yes, but they have a particular expertise. They're known as top-tier makers of premium frozen cakes, the kind you get in major cafe chains or family restaurants.
Ah, okay. High-quality stuff.
Very high quality. They emphasize their unique manual manufacturing techniques for certain products, alongside strong quality control. It's a craft, almost.
Interesting. So who's the PE player here?
After a previous PE investment, Japan's largest venture capital firm, JF SCO Group, acquired Nitto Sweets back in June 2019.
JF SCO, more known for venture capital, startups.
Primarily, yes, but they do growth equity too. JFS saw Nitto Sweets not just as an OEM maker, but as a premium frozen sweets company with real global potential.
And their support was described as very hands-on, particularly with production.
Extremely hands-on, apparently. The key issue they tackled was a bottleneck in production capacity. Nitto Sweets just couldn't make enough product to meet the demand for its premium cakes.
So what did JFI do?
They didn't just advise, they actively helped secure the financing and oversaw the completion of a brand new, state-of-the-art factory in Utsunomiya in 2021.
A whole new factory.
Yes, which vastly increased Nitto Sweets' production capacity. Without JFCO's direct involvement in identifying that bottleneck and then facilitating that massive investment, Nitto Sweets simply couldn't have scaled up to meet the growing demand.
That's a really clear example of how focused PE fund support, or in this case VC growth equity, can drive growth in a specialized niche business like this.
Absolutely critical intervention.
So as of July 2025, Nitto Sweets is still unlisted under JFO. They've made significant progress strengthening the business over the past 6 years since the acquisition.
Which means, again, exit options are likely coming into view for JFO, whether that's an IPO or perhaps a strategic sale to a larger food company that's probably on their radar now.
Okay, so we've covered 9 different companies, 9 different stories. Big reorganizations, successions, carve-outs, hands-on growth support. What's the big picture takeaway from all this?
I think what these 9 diverse stories really reveal is a seismic shift happening in Japanese corporate culture. It feels like a clear move away from that traditional model of slow, conglomerate-led evolution towards more agile, often PE-driven transformation. The key takeaway, I think, for any company in this space now is that success in this new landscape hinges on a real willingness to embrace sometimes radical digital change, optimize supply chains mercilessly, and maybe even redefine what a store or a brand truly means in 2025.
And hopefully understanding these dynamics helps you, our listener, make sense of the forces shaping the economy and the brands you see every day, whether it's your local supermarket changing hands or your favorite snack getting a digital makeover.
Absolutely.
What stood out most to you from these stories we shared? Was there one particular deal or strategy that you found surprising or especially compelling?
And as we wrap up this deep dive, maybe here's a final provocative thought for you to consider. What does this ongoing and seemingly accelerating wave of private equity investment truly mean for the long-term future of beloved Japanese brands, for consumer choices, and maybe even for the very fabric of the country's business landscape in the years to come?
Lots to think about. Thanks for joining us on The Deep Dive.